First of the month, you open your banking app, minus $1,500. Gone. You've done this for years, maybe 5 years, maybe 10. That's over $100,000 transferred out of your life. But here's what nobody tells you. That money didn't disappear. It went somewhere very specific. It's building wealth right now, just not yours. Your rent check is the foundation of someone else's financial empire, and the system is designed so you never even question it. Most people think rent is just the cost of having a roof. You pay it, you live there, end of story. But your rent payment gets broken into pieces the moment your landlord receives it. A portion covers the mortgage on the property. That's the loan your landlord took out to buy the building. Another slice goes to property taxes, then insurance, then maintenance, and whatever is left over, that's pure profit for the landlord. Here's what matters. The mortgage portion is the biggest piece, and every time your rent pays down that mortgage, your landlord's ownership stake in the property grows. That's called equity, their equity, built with your money. According to the Joint Center for Housing Studies at Harvard, over 44 million households in America are renter-occupied. That's 44 million families sending checks every month, funding someone else's wealth. You feel the weight of rent day. Your landlord feels the growth of an investment. Here's how the machine actually works. Your landlord buys a property for $300,000. They put down $60,000 of their own money. That's 20%. The bank covers the remaining $240,000 with a mortgage. Now your landlord needs someone to pay that mortgage. That someone is you. You move in. You pay $1,500 a month. Out of that $1,500, roughly $900 goes toward the mortgage payment. Of that $900, about $250 goes to principal. That means every single month, your rent payment adds $250 to your landlord's equity. You're literally buying them a piece of the building. But it doesn't stop there. The property also appreciates in value. The national average for home appreciation is about 3.5% per year, according to the Federal Housing Finance Agency. On a $300,000 property, that's $10,500 in value added in year one alone. Your landlord did nothing to earn that. The market just moved. So in the first year, your rent payments built about $3,000 in equity for them. Appreciation added another $10,500. That's $13,500 in wealth created by you living there and the market existing. Meanwhile, you renewed your lease. You got a 4% rent increase. And your net worth from housing? Still zero. The property is worth more. The mortgage is smaller. Your landlord is richer, and you're paying more for the same apartment. Now let's zoom out and run the real numbers over 10 years. You start paying $1,500 a month in rent, but rent doesn't stay the same. The national average rent increase is about 3.2% per year, according to the Census Bureau. Year one, you pay $18,000 in rent. Year two, $18,576. Year three, $19,170. By year 5, your monthly rent is about $1,760. By year 8, it's around $1,940. By year 10, you're paying roughly $2,070 a month. Over those 10 years, you paid a total of approximately $180,000 in rent. Let that number settle. $180,000. Now let's look at your landlord's side. Their $300,000 property appreciated at 3.5% per year. After 10 years, that property is worth roughly $423,000. That's $123,000 in appreciation alone. Their mortgage started at $240,000 after 10 years of payments, funded by your rent. The remaining balance is around $190,000. That means their equity went from $60,000 to $233,000. They nearly quadrupled their initial investment, and they collected profit on top of it every single month. Now let's look at your side. You paid $180,000. You own nothing. You have no equity. You have no appreciation. You can't sell your apartment for a profit. You can't borrow against it. You can't pass it down. $180,000, enough for a 20% down payment on a $900,000 home, transferred to someone else's balance sheet. That's not a housing expense. That's a wealth transfer. And it happened $1,500 at a time. So slowly you barely noticed. This isn't an accident. The system is designed this way. Real estate investors call it the rental wealth loop. You buy a property. You place a tenant. The tenant's rent covers the mortgage and generates profit. The property appreciates. Equity builds. Then you take a loan against that equity and buy another property. Repeat. One renter funds one building. 10 renters fund a portfolio. This is how real estate empires grow. Corporate landlords now own over 25% of single-family rental homes in major metro areas, according to a 2023 report from the National Association of Realtors. These aren't small-time landlords. These are investment firms buying thousands of homes at once, driving prices higher, making it harder for you to buy. The system profits when you stay renting. Lenders profit from the landlord's mortgage. Insurance companies profit from the policy. Property managers take their cut. And the tax code gives landlords deductions for depreciation, mortgage interest, and maintenance. Benefits you never see as a renter. You pay more than a mortgage would cost. You build nothing. And the people collecting your check get tax breaks on top of profit. The game isn't broken. It's working exactly as designed, just not for you. The biggest objection you'll hear is this: buying is too expensive right now. Prices are too high. Rates are too high. I can't save enough. And honestly, that's fair. It is harder than it's ever been. But here's the truth that gets lost in that argument. Every month you wait, you're still paying. You're just paying into someone else's equity instead of your own. The question isn't whether you can afford to buy. The question is whether you can afford to keep renting for another decade and have nothing to show for it. So here's what you can do. Starting today. Step 1. Open a high-yield savings account. Not a regular savings account earning 0.1%. A high-yield account paying 4% to 5% right now. Your money grows while it sits there. Step 2. Automate a fixed amount every month. Even $300 a month. That's $3,600 a year. In 5 years, with interest, you'll have roughly $20,000. That's a real down payment in most markets. Step 3. Research first-time buyer programs in your state. Many states offer down payment assistance of $10,000 to $25,000. Some offer reduced interest rates. Some cover closing costs. Most people don't know these exist because nobody tells them. You don't need to buy tomorrow. You need to start building the bridge today. Because every month without a plan is another month funding someone else's future. 2 people, both making $55,000 a year, both paying $1,500 a month in rent. Same city, same starting point. Person A keeps renting for the next 10 years. They never open a savings account for a down payment. They never research first-time buyer programs. Rent increases hit every year. By year 10, they're paying $2,070 a month. Over the full decade, they paid approximately $180,000 in rent. They own nothing. Their housing net worth is $0. Person B takes a different path. They start saving $300 a month in a high-yield account. After 3 years, they have about $11,500. They combine that with a $15,000 first-time buyer grant from their state. They purchase a modest $250,000 home with a $26,500 down payment. Their mortgage payment, $1,480 a month, less than their rent was. Over the next 7 years, they pay down $28,000 in principal. The home appreciates to roughly $330,000. Person B's housing net worth after 10 years, approximately $117,000. Same income, same city, same starting rent. Person A has $0. Person B has $117,000. The only difference is that person B learned where rent money actually goes and decided to redirect it. This is not your fault. Nobody sat you down and explained where rent money actually goes. Nobody showed you the math. Nobody told you about the programs designed to help you. But now you know. You're not just someone who pays rent anymore. You're someone who understands what rent builds and who it builds it for. And that changes everything, because the next check you write, you'll write it knowing the truth. And knowing is the first step to building something of your own.